All right, welcome everybody to a brand new week. Now, before we get into the week ahead, let's just quickly take a quick snapshot of where we've finished the week across major asset classes. I mean, equities just had such a stellar week over the course of the last few days. I mean, it was a solid rally going into the close on Friday. All-time high once again for the S&P, all-time high for the Dow, all-time high for the Nasdaq. There has been a couple of different drivers. Of course, that last big push we had to the upside on Friday came on the back of that slightly softer than expected US CPI data that we had. In terms of other major asset classes, I mean, the dollar, despite the softer CPI, managed to eke out a little bit of a gain going into the close on Friday. I do still like upside when it comes to the US dollar, but we have really struggled to break out of that key resistance zone around that 99.50. I think that obviously the FOMC coming up this week will be a key focus point. But apart from that, the main question mark that we have right now is how long the dollar will be able to sustain this upside despite the ongoing risks of the government shutdown that just keeps on prolonging every single week. Eventually, that could turn into a negative driver. For now, though, it's good to see that the dollar has been able to maintain its current form despite all of those negatives, and obviously on the back of the ongoing issues between the US and China as well. The other key market, as always, to watch, gold. I mean, still lots of pain here from a momentum point of view. There's been so many different reasons touted for why gold pushed lower, why we saw that big flush out in silver. There has been, I think, out of all of the potential drivers, the one that makes the most sense is the fact that the CME, they raised their margins on both gold as well as silver on the 16th of October, which was the top out, that first top out that we had in both silver as well as gold. However, apart from that, as we mentioned many times last week, when something gets this stretched to the upside, at some stage you are going to have very nasty pullbacks, just like the one we had last week. So trying not to make too much of this. I think from a fundamental or a macro point of view, the reasons why people like gold, those reasons haven't gone away. But at some stage, the market just gets too saturated, too overbought, if you will, and you tend to see these nasty flush outs when things get crazy like this. So still a lot of volatility in the mix when it comes to gold. From a momentum point of view, if you take a look at momentum right now, 21-day momentum, that's basically your 1 month price momentum, right? Price is still trading above that. So I think when we could start seeing a little bit more pain playing out for things like gold is if 1 month price momentum falls to the downside. That is a key metric that a lot of momentum traders use for allocation. So if we do manage to see gold close below that, that will be a key level for us just to pay attention to. But for now, again, it looks like a pullback after what has been a massive rally in gold over the course of the last few weeks. Now, in terms of the week ahead, we've got quite a lot of events to focus on. It's going to be packed in terms of central bank decisions. We've got the FOMC coming up on Wednesday. Just before that, we've got the BOC. The morning after that, we've got the Bank of Japan. And then obviously that afternoon, we have the ECB as well. So for central bank decisions, we also have some inflation data coming out for Australia, and we've got earnings as well. Now, let's touch on what I reckon is one of the main events of the week, which will, of course, be the FOMC decision. Now, in terms of what the markets are expecting from the Fed, let's just quickly take a look at that in a bit more detail here. Markets are very comfortably pricing in, very close to fully pricing in a 25 basis point cut for the FOMC for this meeting. We can see here that 24 basis points is already priced in. That gives us about a 97% probability. But this is the Fed, right? The Fed isn't a bank that likes to surprise the market. So when we get any type of probability that is, over 70, close to 80% probability, it's going to be very, very difficult for the Fed not to follow through. So a cut's pretty much priced in and baked in for this week, expected to bring the policy rate down from 4% to 4.25. Now, again, markets have already fully priced in this move for this week, and they've already fully priced in the move for December as well. Now, why are markets so sure we're going to be getting rate cuts? Because remember, we have the government shutdown going on. Even though the shutdown is basically blocking key data points like payrolls data, Fed Chair Powell himself told us 2 weeks ago that they have enough info to move ahead with their decisions. And with the Fed's focus, shifting from fighting inflation to basically protecting the jobs market, he said that some of the recent external information that they have suggested that the labor market has continued to deteriorate even more since the last time they met in September. So that is one of the reasons the markets are a lot more comfortable pricing in still 2 cuts for this year. And of course, we had inflation coming in lower on Friday, which should just give them some additional peace of mind. However, it is worth noting when it comes to that data we had on Friday, read an interesting article from Scotiabank who said that apparently 40% of the CPI data that we got on Friday, or part of that data from Friday, was estimated using proxies because they had huge data gaps. So the data on Friday isn't really numbers that the Fed would arguably want to trust for their decision. But again, it's not about inflation right now. It's about the labor market. And according to their external sources, the labor market has continued to soften, which is why cuts are still on the table. Now, with the cut fully priced in for both November as well as December, what can the Fed realistically do to surprise the markets this week? I mean, with the Fed flying blind with the data, I wouldn't really expect Powell and his colleagues to want to stir the pot too much with new information or, with drastic changes in their tone and their language. But if the chair was to allude to, let's say, maybe December's meeting, if he says something like December's fully priced cut is not a done deal, right? Maybe saying something like, if the shutdown continues, we might have to stay patient after the October meeting. If he drops us a hint like that, any type of reason for the markets to believe that maybe December isn't a done deal, that could obviously be something that could be very positive for the dollar in the short term and very bad for equities and gold. I think it's unlikely, but that is something to watch. On the other hand, if the chair, alludes that despite the shutdown, there is likely a few more cuts in the pipeline even after December, maybe because they are even more worried about the labor market, that could obviously be in the opposite. That could be very bad for the dollar and very good for equities and gold in the short term. But again, I think those are unlikely shifts for the Fed right now, in my view, as there is very little benefit for them to change course or announce a course change without having the data to back it up. Now, something that they could potentially do, this has been on the radar for a couple of banks in terms of their previews for the FOMC, is a potential change to the balance sheet. There is something there that could potentially stir the markets, with the recent rise that we've seen in repo rates, even though it's not a drastic concern from a funding rates point of view. With that recent rise, there has been some participants that is actually expecting the Fed to potentially announce an early end of their quantitative tightening program, with some saying they could either announce an immediate stop this week, while others say that could actually just announce that, yes, we are looking to stop that over the next month or 2 or 3, etc. If they do go ahead with that, that could prove even more positive in the short term for equities as well as gold, and that could be a short-term negative driver to watch for the dollar. Apart from that, if we don't get any changes on the balance sheet, I'm just not expecting these guys to ruffle any feathers. It will, of course, be the FOMC, so there will, of course, be short-term volatility, both up and down in things like equities and the dollar and gold, but it's just not something that I think is going to create a massive amount of flow unless we get that balance sheet surprise coming out from the Fed. Now, in terms of key assets and levels to watch, on a potential more dovish FOMC, obviously upside levels to watch there. You've got the weekly implied volatility high coming up around that 4,200 level. Now that marries up very nicely with that low that we've got from the 17. So quite nice to see that. And then above that, you've got the second standard deviation one and the third coming up right on top of all-time high. So those will obviously be key levels to watch for us for the week ahead if we see the Fed tilting more dovish. In terms of a more hawkish Fed, that would be a surprise. But if that does happen, obviously we've got key support coming up around that 4,000 level. It's the prior lows going back to last week as well. And like I said, 1 month price momentum is just below that 4,040 level. So definitely something worth watching from a level point of view for gold for the week. In terms of the dollar, I mean, wide range here, but we've got the high of the week marrying up nicely with the high back in the from the 1st of August. That's good to see. And you've got the implied volatility low marrying up nicely with that 97.70 key support level as well. So two key big zones to watch. Look, again, I doubt whether the Fed does anything to see this type of levels reached, but you never know, and it's obviously just worth paying attention to those key levels for the week ahead. In terms of the equity markets, look, these levels on the weekly basis is absolutely massive. We've got the weekly implied high sitting at 7,000, which seems miles away, but again, if the Fed is very dovish, that could certainly be reached. And in terms of the weekly implied volatility low, that comes up around that 6,600 level. So pretty key or big levels there to watch. Huge volatility potential for the week. We've also got a lot of massive earnings coming up. That has also just increased likelihood of slightly bigger ranges for the volatility spectrum this week. So just keep that in mind, but we will touch on that in a second. Now, apart from the FOMC, the other one that could potentially move the markets this week is the Bank of Canada. Now, markets, if we just quickly go back to red expectations here, markets are leaning heavily towards another 25 basis point cut from the bank. We can see 23 basis points is already priced in. So that gives us about a 94% probability of a cut. Now, even though rates pricing is very, very clear on what they're expecting, there isn't as big of an agreement when it comes to the analyst community, because in a recent Reuters poll that they did, out of the 34 analysts that was polled, 23 of them saw a cut in line with rates markets, but 11 of them, basically 30% of them, actually still expect a hold from the bank. All right, so that is quite interesting. You can see here, out of the 34 that was polled, 23 of them expecting a cut, but 11 of them expecting an unchanged. Now, it's always interesting when we have that type of divergence between what rates markets are fully pricing in, and then you see that, hey, listen, the analyst or economist community isn't actually agreeing. There's a little bit more of a nuance and a divergence there. Those types of things can create volatility, because it means that someone at the end of Wednesday's decision, someone will be left holding a bag, and that can create some expectations. Now, let's talk about these two camps for a second, right? Why are some so very, very clear on expecting a cut, and why are those? What are those that are expecting a hold? What are they saying? Why do they say that? In terms of the cut, the reasons for why is we've got a super weak growth backdrop for Canada right now. The economy is barely growing. You've got the labor market that continues to cool. We have had that recent print that came in hot, but in the aggregate, the forward-looking or soft data, as we call it, has been showing deterioration in the jobs market. You've got trade tensions and the uncertainty. We've got that. We had the abrupt end to the trade talks between the US and Canada, obviously, this past couple of days. That has soured sentiment and increased the likelihoods of a bigger risk to growth. And you also have markets already fully pricing in the cut, right? So with an odds already above 90%, not cutting could cause unnecessary tightening via market reaction. So policymakers in the Bank of England might prefer to just validate those expectations as opposed to trying to surprise the markets. Now, what about those who are looking for a hold? Why do they say that? Well, inflation is one of them, right? The September CPI data surprised sharply to the upside. Sharply, right? We've got that, the bank's preferred measure of inflation. If we just quickly take a look at that chart, we've got the preferred measure of inflation for the BOC, still uncomfortably above the bank's 1 to 3% target band. Let me just quickly show you guys what I'm talking about. So if we go to that BOC chart, you can see that we're sitting at 3.2% for the bank's preferred measure of core inflation. For some, that's enough to say, hey, maybe the bank just wants to play it safe and just kick the can down the road. The other one is the labor market. Even though the soft data, the forward-looking data is showing deterioration, the actual hard data that we've got came in pretty good. I mean, we had 106,000 jobs that was added, permanent jobs that was added with that recent print that we had. So the soft data is showing slowing, but the hard data, the actual employment data, came in pretty good. There's also fiscal stimulus that's coming. You know, a new federal budget is expected, I think, early November. So that would likely include some fresh spending measures, which should be good. And obviously, you know, there is risks that the flare up in the recent trade tensions again between the US and China and Canada could actually spur a little bit more upside for Canadian prices as well. So there's those things. And the other thing to keep in mind about the BOC, which I think a lot of people forget, is that unlike the Fed, the BOC they couldn't care less when they surprise the markets, to be honest. You know, they've done it so many times in the past. I would not put it away from them for surprising again. So it is possible. So what could that mean for possible opportunities? Look, because a cut is fully priced, the only thing that will really surprise the market is if the bank decides to hold rates. If they do decide to surprise the markets with a hold, that could cause that's going to cause an immediate shock for rates markets, because they've already fully priced in that cut. And that could obviously drive the CAD sharply higher in the short term. And that could potentially, that type of surprise could potentially see the dollar CAD trading back down towards 139 in a hurry, that key support. If that happens though, does a surprise hold really change anything for the Canadian economy? Not really. Does it really change that much for the bigger picture in terms of rates? Not really either, because let's just assume that they hold rates and they don't cut. Once the markets have priced out that cut that they've priced in, the markets aren't expecting any more cuts after that. So if we just wipe out this one cut, if we price that out and the dollar CAD drops, then we're just right back to square one. And, you know, from a fundamental point of view, if you look at growth, if you look at inflation, I think there's more reasons for the dollar CAD to be going up as opposed to be going down. That's why we traded that higher over the course of the last few weeks. So if we do see a surprise hold and dollar CAD pushing lower on the back of that, I might look for any type of support around that key zone for some upside opportunities. The bigger risk there is that we have the FOMC coming up a couple of hours after the BOC, so maybe it's worth waiting for the BOC or for the FOMC as well, and then pulling the trigger. But I do still like this from a fundamental point of view for upside. Obviously, the risk is that they hold, and if that happens, there could be some other opportunities. Now, what about some of the other decisions? We've got the Bank of Japan coming up. Now, for those of you who's listened to me for a while, you'll know that I absolutely hate the Bank of Japan policy decisions. It's just such a horrible thing to try and trade. Let's start with what markets are expecting. If you take a look at rate expectations here for the BOJ, markets aren't expecting anything from them over the course of the next 7-8 meetings, right? You can see that hold probabilities is by far the biggest share. Now, there is still some tightening expected. You can see that the markets are basically fully pricing in one hike by the March decision. But a lot of this will come down to what the new PM will allow the Bank of Japan to do, right? The reason why the markets are so comfortable that we're not getting anything this week is because the new PM, Takahashi, she's very good on or big on stimulus, right? And the markets are viewing her as a key reason why the Bank of Japan won't be in any hurry to hike rates, at least in the very, very short term. Now, what's interesting is that you would assume that after the recent victory by Takahashi, that the markets would be more comfortable pricing in 100% probability of a hold. The fact that we 80-20 is quite surprising going into this decision, because we even had the Bank of Japan themselves coming out telling the markets that, hey, we do still want to hike rates eventually, but not right now, at least not at this upcoming meeting for this week. So it's a bit weird that we're not at 100% probability, but this is the Bank of Japan that we're talking about. Maybe the markets are just so used to them being so bad at their communication that they just don't want to take a chance when it comes to that. Some other reasons why the markets are expecting a hold from them, apart from them obviously telling us they are going to be on hold, is the trade tensions. That's adding uncertainty for the market right now. The whole new flare-up between the US and China. that could weigh on Japan's exports outlook. So that is something to watch. And the recent data has been very mixed. You've had manufacturing and household spending that's softened. Wages haven't really picked up enough to justify a hike right now anyway. So there's different reasons for why the markets are sure they're not going to be hiking rates. So with a hold basically baked in, what can surprise the markets? You know, the thing about the BOJ is that they love surprising the markets most of the time, you know, but it's very annoying from a communication point of view, because whenever they do hawkish things, they normally pair it up by saying dovish things in their comments. And whenever they do dovish things, they pair that up with saying hawkish things in their comments. They try their best not to cause big moves, and they end up doing the exact thing that they want to avoid. And then they end up blaming the markets for not moving in line with the fundamentals, right? It's just such an annoying bang to watch. I mean, so just be careful with this one. I hate trading the yen out of the Bank of Japan and Japan decisions, because it's just a mixed bag most of the time. And we don't have a firm time for the Bank of Japan either, because it would seem that even though all the other major central banks can stick to a solid release time, the Bank of Japan somehow thinks they are very special, and that time is only relative, right? So you have that frustration as well, is that if you want to trade it, you basically have to sit and wait around for 3 hours and hope that you catch the decision, and then you have to wait another 2 hours for the press conference. The bottom line is, you know, it's just not something that I like to trade for a couple of different reasons. If you absolutely had to trade it, what could you watch for? Look, if UADA hints that inflation could hit their target sooner, or if they massively upgrade their forecast, the yen can obviously rally on the back of that. If, however, they come out and they stress the downside risks to growth from tariffs, or if they say that the recent political changes means that they might be keeping rates where it is for a little bit longer, all of those types of things could be more dovish, and that could send the yen lower. But again, guys, it's the BOJ. It's just not something that I would be wanting to trade. But for those of you that are holding yen exposure, it's definitely something worth, you know, keeping on the radar. A little bit later, also on Thursday, we've got the ECB. The bank is fully expected to leave rates unchanged. You can see here by expectations across the curve next year, there's absolutely nothing expected by the bank. If ever there was a meeting that you could probably avoid, this would be the one. The markets are not expecting anything from them. The main event will be the press conference, where traders will be listening, you know, to any hints about whether the ECB, whether they're truly done cutting rates, if there's any more information. But, you know, even at the presser, the markets are just not expecting to hear anything of value this week. So again, if ever there was a meeting to ignore, it's probably this one. The main reasons why the markets are expecting a hold and not expecting anything new is because for now, nothing massive has really changed. Inflation is near their target. Growth has been stabilizing. It's not super sexy, but it's been stabilizing. Financial conditions remain loose. They already cut 200 basis points over the course of the last cutting cycle. And the labor market remains fairly tight. I think we've got wages that's still growing around 3 to 4%. So the ECB they've got no reason to do anything. And that's why the markets are really just, you know, expecting this to be a nothing burger from them. Out of everything this week for the ECB, or rather for the euro, I reckon the GDP and the inflation data that we'll be getting for the Eurozone, that might actually be, if we are going to get a move in the euro from data or risk events, it's probably going to be from those and not the ECB. Again, if we have massive surprises, either to the up or to the downside for GDP data or inflation data, that's probably going to be a bigger mover for the euro compared to the ECB. Now, the other one that I am looking forward to is Wednesday's inflation data, quarterly inflation data coming out from Australia. Now, this will be the Q3 CPI report. And it could be a big one for the Aussie. You know, the markets are expecting about a 1.1% in the quarterly number, up from 0.7. They're expecting 3, up from 2.1 for the year over year. But the more important ones, obviously, to watch is the bank's preferred measure of core inflation, which is weighted, it's the trimmed mean quarter over quarter and the trimmed mean year over year. That is also expected to go up on the quarterly number from 0.6 to 0.8, and the year over year is expected to stay at 2.7. Now, this print will likely decide whether the RBA cuts rates in November or not. If you take a look at rate expectations right now, you can see that the bank or the market is pricing in about 18 basis points of easing. So the higher probability move is a cut, but it's only sitting at about 70% probability of a cut, 20% or 30% probability of a hold. So whatever happens at this with this CPI, that will most likely dictate whether the market's fully pricing a cut or whether the market's actually trimmed down those cut expectations. The reason why this print matters is, firstly, growth is soft and has been softening. The labor market, which was stable, got a little bit of a scare with that recent print, right? Unemployment jumped up to 4.5%. Now, again, the unemployment jumped up because of participation. But if that ends up not being a blip, if that ends up being something that is, pointing to real weakness in the labor market, that's obviously something that the RBA will want to pay attention to. Consumer spending has been flat as well. The only thing that hasn't played ball enough for them to cut rates more has been CPI, right? So with CPI trading, at least on the monthly level, close to 3%, that's a really hard situation for the RBA to justify cuts. But if CPI, at least the quarterly one that we know they pay a lot of attention to, more so than the monthly number, if that can come in lower, then obviously that there's no more reason for them not to cut rates then. So that's definitely something worth watching this week. In terms of that trimmed number, what can we expect to move the markets? Look, I reckon on a quarterly basis, if we get a quarterly number that prints above 1%, that will probably be enough for rates pricing to drop down from 70-30 down to 50-50 for that November meeting. And even though that would be worth a short-term pop higher in the Aussie, with the recent growth and the labor data deteriorating, if inflation surprises up like that, that puts a lot of stagflation risk back on the agenda, right? So I wouldn't look to hang around in any Aussie longs for too long if the print is that hot. It's definitely worth looking for some short-term upside in the Aussie, but I wouldn't want to be staying around because of the stagflation risks. To the downside, though, if we were to see a trim inflation, especially that important year-over-year number, if that can print, if either the quarter-over-quarter or the year-over-year can print at or below the prior numbers, so at or below 0.6, at or below 2.7, if we see inflation at the quarterly basis staying flat or pushing lower, that should be enough for the markets to fully price in, or at least get to an 85, close to a 90% probability of a cut. And then you've got growth slowing and the labor market slowing and inflation not accelerating. There's no more reason for the bank not to cut rates if that's the case. My preferred trade on the back of that is still the Aussie Kiwi. We had a good trade on the back of that a couple of weeks ago with the RBNZ decision. If we were to see CPI surprise to the downside, I think Aussie Kiwi downside could be really sexy on that front. We've got a key level of support here around that 112.70. You've got the weekly implied volatility coming up at a meager 112.50. If that folds and it's a real weak number, I'm not sure whether we get there next week, but if we do get a nice miss, I would potentially look for a possible move back down towards that 111.50 psychological and key support from a couple of weeks ago. That'll be a key level that I'll be looking to target if we get a weak number, because that should just set in motion once again a little bit of policy differential between the RBA as well as the RBNZ. Now, apart from that, there's a couple of other things we have to watch for the week ahead as well. Firstly will be month end, official month end. We've got corporate month end coming up on Wednesday and official month end coming up on Friday. What does that mean? Corporate month end is T-2, so that means any corporate FX needs will be settled on Wednesday. for the month end. So watch out for any funny price action in FX around that 4 p.m. London fix, especially heading into Wednesday. And obviously for Friday, official month end, again, watching the London fix moves around that will be important. If you see any very, very strong FX selling or buying around that 4 p.m. London window, it might just be corporate demand or month end demand playing out. So just pay attention to that. It's very difficult to plan ahead for that and try and trade out of that. It's just worth knowing that, hey, if you do see massive vol in FX around that 4 p.m. window, it's probably just the London fix playing out. The other big movers or potential big movers we need to watch is, of course, earnings. It's an absolute monster of a week, guys. We've got big names. United Health is coming up. Visa is coming up. You've got Meta, you've got Microsoft, you've got Alphabet, Amazon, Apple. It's going to be big. If you take a look at the weightings, the reason why these names matter so much, for example, Visa, it's got a 7% weighting in the Dow. United Health, 7% weighting in the Dow. These are important names for that. Caterpillar, 10% weighting. In terms of overall market exposure for the S&P and the NASDAQ, you've got those big names, right? Alphabet, 5% S&P, 9% in the NASDAQ. Meta is coming up at a 5% for the 5% for the NASDAQ. You've got Microsoft, 6% S&P, 11% NASDAQ. You get the picture. These things, if they surprise massively on earnings, it can really impact the broader market as well in terms of the S&P, in terms of the NASDAQ. So it's not just about watching this from a single stock perspective. It's always good just watching this from a broader market point of view as well, for its potential impact on things like equities as well as overall risk sentiment as well. So with that said, it's going to be a busy week, lots of events, lots to pay attention to. As always, I hope everybody will have a fantastic week ahead. And if there's any questions, don't hesitate to let me know.